All right, what's up, everybody?
Let's go.
What we're going to do today, before Steven gets trigger happy here with videos, is we're gonna answer your questions. We're gonna literally dissect it. We just did the last March Money Madness episode. We had almost 300 people on there. Literally, it was rapid fire questions, and we weren't able to get through them all. So we're gonna get most of them here with this Brady Bunch crew. But we're gonna do that after Steven plays the video. Or
Take two.
All right, we're back at it. Cool. Super pumped, super excited to have all of you here, super excited to have the whole team here. Let's dive into the questions because this is Ask Us Anything, and that's what we're going to do. So let's go around the block, starting with, well, Steven just pieced out. Starting with Shauna.
But just saying hello?
Yeah, let's just go around the block.
It's our first time, everyone. Let's help each other out. We're going
Hey, everyone, we'll get through this fast, but I usually just moderate most of the questions, so I'm here to read your questions out loud to this lovely panel of people. And I'll pass it over to Brian Fouts, who hosted What the F this morning.
Hey everybody, Brian Fouts here. Yep, up here in Idaho. Yeah, I had a blast on the WTF this morning with Andy Tanner. So if you guys don't know Andy Tanner, he's one of Robert Kiyosaki's original trainers and speakers. The guy's amazing, and he had a lot to say. So if you haven't seen that, go check that out. But had a lot of fun with him this morning. That guy, he's a wealth of knowledge and a great speaker. So yeah, it was fun. Shauna, you were there.
Yeah, it was great.
Yeah. So with that, I'll hop it over down to Carson.
What's up, everybody? Coming to you guys from Southern California. I wish I was on WTF. Andy Tanner's awesome. I want to watch the replay now, too. So when does that replay come out?
It's probably on the channel right now under the live section, and it was easily 90 minutes, I feel like. Right, Brian? You guys were on there for a long time.
Wow. No longer than 90, actually. a little bit longer.
That's awesome. If you guys don't know Andy Tanner, go look up his name and his book, 401 Chaos. It's awesome.
And he's writing the second one right now. So that one's actually out of production now. And his second book is coming out, I think, here next month. I'm excited for that one, too. That'll be cool.
That's awesome. Yeah. Well, not much going on over here. Let's move it over to Mr. Jason.
Thank you, Mr. Carson. Hello, everybody from the city beautiful. Stephen Nagy's favorite place in the whole world. Super grateful to be here. Looking forward to answering questions. And now down to Mr. Yennymeister.
Wow, we're bouncing all over the place here. Craig Yenny from Colorado. And just because we have so many people here, I'm not going to keep rattling. But what I'm going to do is I'm going to go all the way up to Ethan in the corner.
Hello, guys. Ethan Evans from Michigan on the implementation team and also Money Mentors. So glad to be on here and help answer some questions for everybody. I'll go down to Bree.
Whew, sorry about that. I had a client calling in while we were on. I'm like, go here. We're live here. I'm Bree Shaw, or Brianna Shaw. I'm partnered with Joseph Kovacevic. So we're just here to share the experience. I've been doing IBC for 3 years. Huge fan.
That's how you say his last name. Thank you, Bree.
Well, that's the English way. There's another way. I'm not going to butcher it. But I'll hand it down to Joe.
All right. I'm at the end of the waterfall, it looks like. And I'm up here in Buffalo. And yes, it snowed today. And I wasn't happy looking out the window when I was on the calls today. But it didn't stick. And I still see green grass. So I'm happy.
Don't forget the six blades, cow cuddling, farm owning man above Joe. Don't forget Mr. Gabe Ratana there.
Okay, then we go.
Hi, everyone. Thank you. Yeah, no problem. Gabe just finished renovating the farm that Jason spoke about. Been blessed to be able to practice this concept for about 6 years now. So I've tried a lot of different things. I found what I like and understand and hope to get really, really good at. So I'll be here sharing and trying to learn and get myself to grow and help everyone grow along the way too.
All right, I'm going to kick it off with a couple pre-submitted questions that we got from Landon. So he says, I'm in the process of getting a first lien HELOC, and then in what order would you pay these items? So he's got $20,000 into PUA with Guardian, $83,000 loan with Guardian at a 4.76 loan rate, and then $58,000 in loans with Mass Mutual around 5.39. And we'll start there, and then he's got another question.
I say PUA first, $20,000 into your PUA, because you always want to run money into that. And then as soon as the cash value is able to take out again, that money needs to come back into your HELOC, because your HELOC is the main operating account. What are you going to do with that HELOC now? Are you going to put that money into action? Because you should have debt consolidated if you have a first lien HELOC. No more mortgage, no more debts, no more third-party debts, just the loans on the policies. So now let's get that money to work. Let's put that into an opportunity to make more cash flow coming into the HELOC. And then our goal is to get out, lent out, making us work the amount of money that we owe in the loan. So then when the opportunities come back to us, we can then fill up that bucket.
Just to add on to that, you want to be always thinking about what are the dollars doing. So by paying that PUA, you're increasing what overall is compounding and working for you in interest and dividends. And as soon as it processes in Guardian, just did it myself with my Guardian policy. I ran the money through the PUA max right up to that MEC limit. And as soon as it processed in the cash value, I put it right back into my HELOC, because the opportunity cost of the dollars that are already being used in the HELOC, that's a lot more than the little simple interest rate for the loan in my Guardian. So I would rather the dollars be in the HELOC, because they've already been captured in this pot. They're still going to be working there. Might as well have them work here.
But that money can't sit there. It needs to get put into action.
Oh, correct. Yeah, you just need it to go run through, and then you're creating passive income, baby. Cash flow is king.
All right, any more?
I definitely agree with PUA first. I can't. I was like listening to everything everybody was saying. I guess I agree with that. Craig, are you in agreement with that? Like, you're the sheets guy.
Well, one of the things I would want to know is, what did you do with the money you took from Guardian? What did you do with the money you took from Mass Mutual? Because I'd want to know, did that pay off some debts? Were you originally paying some payments on those debts that you no longer are? Where did that money go? Or did you use that for an investment? And what are you doing with that money? So like Joe was talking about, you kind of cycle all that back into the HELOC, but I would want to know more about, historically, what did you do to get those loans? What was that money used for? Did they pay down debts? Did you have debt payments you can make back to your system to be an honest banker? Did you use it for investments? What are you doing with that passive cash? So those are the things I would want to know.
Well, then is the elephant in the room, like, let's say you just take money from the HELOC and you just pay off the $83,000 loan and a $58,000 loan, you still have that. It's just titled HELOC versus Guardian at 4.76 and Mass Mutual at 5.39.
And you're still paying an 8% to the bank.
Yeah, we use the HELOC as the one pot system nucleus. So that's the savings account, the checking account. And that's where the money is temporarily at its waypoint between when it's coming from the income sources, or when it's being deployed to the investments, or when it's being captured and run through the policies, just to keep earning and increasing that death benefit.
Yeah, the other piece I would consider is between the Guardian policy and the Mass Mutual policy. With the Guardian being direct recognition, I'd rather get that loan out of the way, because it can impact your dividend crediting.
Oh, it will.
Yeah, my loan that I just had out, I went from around maybe 1,300, could have been dividend, down to like 200 and something.
Yeah. So. Whereas your Mass Mutual is not going to have dividend impacts on your loan. So I would prioritize the Guardian loan over the Mass Mutual loan.
And at the same time, if your HELOC's at 7, 8, 9%, though, why would we pay off a Guardian 4% loan when we'd have a 7, 8% HELOC?
You wouldn't. You would.
That's why the opportunity always lies with the HELOC, because it's a higher simple interest rate than the loans to ourselves.
Yeah.
But that's where it depends. What is the policy's purpose? What is it for? If someone has a policy that's strictly for savings or something that they're just trying to grow and build up, then by all means, like, that's just the money you're not one to touch. Just know when you have your HELOC that's paid off a mortgage or is being leveraged for any number of things, whatever dollars are being allocated from that credit line, you're owing money on. So you can have money sitting over here where you're not owing anything on it and you're earning the full amount of dividends that you can on it, but you're still being charged 8%, whatever percent over here. It just has to make sense for the dollars for you.
Yeah. And one last thing to add on to that for Landon, I mean, there's lots of different ways to slice and dice this thing. It has to make sense to you. Until it makes sense to you and how you see it solves your problem, keep asking questions until it makes sense. Don't do anything until it makes sense to you. Like, that's one of the things that we see a lot, or I see a lot, is someone takes action too fast without it making sense. Then they're having to play catch up. So make sure that it makes sense to you, whatever you do. So keep asking questions, keep talking about it so it gets clear for you.
I got a question. Why is StreamYard telling us we can only have 10 people? So Steven's backstage. Like, what in the world is going on with this thing?
Yeah. Steven went.
Yeah. Never had that many on, I guess.
That's okay. All right, I'm gonna hit on the next. So Landon also submitted a different question too. So can you talk about the different companies and when you would use one over the other, assuming each company offers the same rating? For example, one that gives more PUA flexibility, easier account access, or better customer service, etc.
Absolutely. Yeah, of course we would use companies. It depends on what you're trying to accomplish, what you're trying to solve, and to making sure that you're with the right company that can help you accomplish that. But yeah, those are all factors that we have to consider. And obviously you ask us questions when you're talking to your mentor, and we can help you with that. But yeah, absolutely.
And I think, Landon, specifically, I know you're looking for specific answers on the 5 different mutually owned dividend paying companies we work with. And there are different reasons based on, like, we can give you the factors that we're looking at. Like, is it based on someone's age? Is it based on their health rating? Is it based on maybe the size of the dumping that they want to put in because they need more immediate cash value and they're trying to do something with investment? If you want to learn how to be a banker and actually function in banking and do what's on Nelson Nash's page 51 with equipment financing, then we might go with a different company and show you a little bit more depth on how you can add additional PUAs in, with what the company allows us to do. So there's a lot of different factors on age, the state you live in, your health, your income, what you're trying to do. Like, some folks might say, hey, I've got this big windfall, but I make this amount of money. And then if you bring them to one company, they're underrated for too much death benefit per how old they are, per how much they're making, and they have this big windfall they're trying to put in to get it moving again. So then that's going to tell us where we need to go as a mentor. We're really there. The clearer you are on where you want to go, the better we can dial in exactly how to help you.
All right, great answers, everybody. Cobb is saying, hi, everyone. Chris, what do you say to the spouse that does not see the potential to do this and uses a HELOC and is afraid to lose the house? How secure is the system so that they can feel fine? And maybe that's in conjunction, a HELOC and a policy. So I feel that risk. Oh, Chris, you're muted. Sorry, someone's got to go. So Chris can get in.
I can go, guys. No problem. See you later.
Bye, Gabe.
Bye, Gabe.
Chris go?
This is wild. Put Chris in the middle. Okay. He's like the
Yeah.
dad. Put him in the middle.
So freaking wacky. Like,
We'll upgrade it or something.
Yeah. Anyway. Okay. So yeah, I totally see what you're saying with your spouse. Like, actually normal. Your spouse, that's your house. That's, where your kids are. That's where your family is. So, if they're not sure about what's happening with the money from the HELOC, of course, there's going to be some sense of nervousness. So I think the most important thing to identify here, because you're talking about really 2 different things. You're talking about a HELOC, and then secondarily, you're talking about the policy. How secure is the system? So if we're talking about the policy is about as secure gets. Like, you can't lose money in the policy. The only place it can go is up. Now, in the first, couple of years, as you know, because you've probably seen the illustration, if you, I'm just guessing, but if you were to take money from the HELOC and put it into the policy, there's one thing that's going to happen there that you got to be really careful of, because now by doing that, the HELOC is going to start charging interest, and the money goes into the policy, and the policy is growing at a lower rate than the HELOC. So you can't just do that. So if you were talking to your spouse and you're trying to explain this, if it was just a lateral move from HELOC into policy and you're done, it's not going to pencil for years. So I would agree then that your spouse would probably be like, I don't really like this idea. With a spouse, I always talk about the death benefit, the protection, and everything else. That usually gets them over the fence. But it's really where the money goes next, right? From the policy to where is it going next? That's the single most important thing. Now, maybe it's paying debt off. That's pretty much risk-free, because if you pay debt off and you pay the policy back, the amount you were paying to the debts that you were doing, now that's supported. But we still got this this problem that we got to solve, which is the interest charged on the HELOC. So it's just math. Like, if you're going to do this, I think the most important thing and the way to get it across for your spouse is just have Craig run the math. Have somebody on this team run the calculator for what it is you're trying to do. Then let her be on that meeting. Now, if she doesn't want to get on the meeting, then I don't know what to tell you, because she's just closed-minded on that. But if you can get them to see the mathematics of what this is doing and explain, the risks with that, which we could easily explain, then I don't think you're going to have an issue getting that across the finish line, unless she won't jump on the call to see the mathematics.
I guess one of the things I was thinking about, Chris, as you were talking about that, is with what you're doing today and how it's working, is that going to get you where you want to be? And so I think the first question for your spouse would be, where are we going with this whole thing? What are we trying to do? And then back into figuring out, is what you're doing going to get you there? And if not, then, book a call with one of our mentors, or I'm happy to do it as well, but just to figure out, what are the alternatives? What can you do with the money in the HELOC? What could you do with the policy? What could you do? What is the thing you want to invest in? And just put a plan together, because if you don't know where you're going, that's the first problem. You need to figure that out. What are you trying to accomplish?
And a lot of times with the skeptical spouse, having hundreds of these conversations, is there's some injury there in the past. There's things that you've tried that haven't worked out. There's still a feeling of uncertainty and doubt and fear. There's a lack of trust between the two of you when it comes to money. There's money conversations to be had. You have to invite money to be welcome in your family. There has to be a rethinking of your thinking there, optimally, where you're looking at, like Craig just said, he said it beautifully, like there's guarantees everywhere. There's a guaranteed growth. There's a guaranteed death benefit. That's a tax-free estate for your family. But you're not going to hear that if you're believing that the person that is your partner is putting you at risk again. So dig deeper, really ask the question to yourself, like go do it, the investigation, and watch Nelson's video. I've been told that he's the spouse whisperer, and I've been sending it to any of the skeptical spouses, and I've had a couple people come back and be like, oh yeah, I'm all in. I'm all in. Like, I like that he starts off, just watch it. I won't ruin it for you, but watch it. And that'll give you a little bit more certainty. It'll make you feel like, oh, wait a minute. This is for me. This is a solution. There ain't nobody selling me anything. Because that's one of the things you're afraid of too.
Heather just chimed in too. She said, I was the skeptical spouse. Now I'm the biggest advocate. And then Jason gave me that YouTube link to that documentary. So it should be in the chat for you guys.
I was married to that skeptical spouse. She thought I was a lunatic. She said, what are you doing? Like, I'm just going to stay over here and do my thing. And now she jumped on a call earlier today to try to save somebody that was talking to MPI. And she's like, don't do that. I was listening to Sammy talk. And you got to talk to Sammy. And we talked about it in our team meeting. But she went from someone that is now building our ecosystem. She's in support of everyone. She sees the people that are saved and helped and how it changes marriages. So she went from being that skeptical spouse to being all in. So
I love it. Next question is from Shane. He said, when you camp for the unload the policy, what is the most when you camp for unload the policy, what is the most effective way to get the ball rolling and start the banking functions of your life? Still have car loans, still have a little bit on credit cards.
He's just saying you can't front load it because he sees, you know, a lot of the designs we're putting out there, and even, you know, we're putting 10,000 a year to buy the car, right? You're capitalizing system. You're putting 25,000 a year if you're the doctor. The first thing, Shane, is to get your savings. Start paying yourself first. Change that one thing that we're all saying every single video, which is you make this much, you spend this much, this in between is what you have to start paying yourself first. Build that habit to pay yourself first. You can capitalize your system slowly, monthly, over time, and it'll build up to a bigger amount. But it starts with changing that one thing, and that's paying yourself.
I mean, I'll say this: when I first started, I didn't start with a dump-in, and I don't know many of you here that did. I mean, I think because we do show the dump-in so often, just because that is the kind of norm for us now. Most people are doing dump-ins, but you certainly do not need to do dump-ins. I started literally just, it was a grind. It was, I put, you know, $1,000 a month in. That was my first IBC policy. I had lots of debt, and every quarter I would take a loan from my policy. I would pay down debt. Notice how I didn't say pay off debt, pay down debt. After one cycle, I would get the new credit card statement. You can do it all online now, and you can see what your new payment's going to be. I would take the difference between what I was paying the credit card to now what the payment would be, the minimum payment would be, and that's the amount that I recaptured. I did this every quarter, and I got out of debt doing that, and it was just a slow grind, but it worked exactly how we teach.
Yep. I had a client today, exact same question. It was like, how to get started? I want to do a dump. I want to do this. I want to do this. I said, well, where are you at right now? Where do you want to be? I go, start with where you're at right now, knowing that you can actually upgrade this as you go through your life. You can do more and more, but start with where you're at today. Get that ball rolling. And I had a good analogy for him, but it was like, you know, if you don't plant the seed, it will never grow. And this guy's been thinking about infinite banking for years now. He's in his 20s though. And I'm like, plant that seed, let it start growing. You can plant more seeds, but you've got to take that one step and plant that first seed. Otherwise nothing will happen. So, and
So Shane, during the strategy calls, what we're typically doing is understanding how is the money flowing through your system. And there are some cases where we just can't find any extra pennies laying around. And so you might be already paying your minimums on your credit cards and your car loans. So here's the thing, you may have to wait a few months until you can knock a credit card out or two. Then, like Chris was saying, you can run that money into the policy as the premium side. So it may be one of those things where you have a discussion with our team. We look at how your money's flowing. We come up with a way to make it work, or we say, do this and this, and then we'll start the policy. So it just may be a not now, depending on your specific situation, but you can do it if you stay disciplined and knock some of those bills out of the way.
Just to add to that too, Craig, I was meeting with a couple of clients today, a husband and wife. They're, small business owners, and they were, laying out, okay, I've got these debts I want to pay off. I've got these goals, and similar to what you guys are saying, okay, well, let's start small. Like what goals do you want to be able to take care of in this first year with this policy of, putting in a little bit of savings and then being able to pay off the debt from there. So yeah, we always just have to tie it back to what are your goals and where can we start somewhere that's safe and comfortable and we're not, reaching too far and getting ahead of our ski tips.
Yep. And we've got a tool called the Debt Blaster. We can put all your numbers in, turn the crank, and then show you what it looks like.
We don't charge people to show them how they're going to get out of debt? Come on.
No. We should, but we don't.
That's crazy. That's too good to be true. You're full of it, Yenny.
Purple unicorns and rainbows.
He is. I thought he was going to throw back a dad joke at me. I've
got plenty of dad jokes, but we'll just hold those back for now.
Why didn't the teddy bear have dessert?
I don't know.
He was stuffed.
Well.
All right. That little brown dog is saying, can IBC benefit organizations like churches? If so, what are some differences between policies owned by a nonprofit organization like a church versus a policy owned by a private individual?
I've had this conversation quite a few times recently with people that want to have them on like the pastor, something like that. It's really not that much different than an individual policy, because the question is, what are we solving? What are we going to use it for? I mean, that's really the question. It's the same question. It's the same exact
Who's
question.
the insurable interest, right?
Yeah.
But
So what would need to happen there, that little brown dog, is that if, let's say, for example, you were going to put policies in the church, it would, like Brian says, could be the pastor because there's a insurable interest there. The church could own the policy, the church could pay for the policy, and the beneficiary is the church, but it's on the pastor. Joe, we just did worked with some folks on a school, a nonprofit school. So there's a lot of different ways to do it. And Brent's just mentioning there. So as a nonprofit, and Brent, can speak to this as well, but they have teachers that are critical to the operation of their business. And if, God forbid, something happens to those teachers, they're going to have a loss. So that's just one example, but that's how we did it with Brent and his team.
Great example.
Awesome. And then, are there any of you guys that specialize with this that he can link up with?
Yeah, I mean, we already did it. So, Joe, Craig.
Joe or Craig?
Okay. Yeah. So reach out. I don't know, Joe, do you want them to reach out to your warden?
We can do that. Just on my email.
Yeah. So you can reach out to Joe, and then we can work on that together. But it's reach out to Joe. He'll get you started on what needs to happen there.
Yep.
All right. Derek is saying, how would you guys go about buying your first home?
Well, Derek, if I gave you two choices, you could get a loan and you'd pay me X amount over 15, 30 years. I'm going to charge you an amortized interest rate. And when you pay me, that's it. You're not getting any of the money back. But at the end, you'll have your house. I'll have your money. Or I'll give you a line of credit and you can get your house and you can contribute to it. When you pay me a certain amount over this simple interest, it won't be amortized. You'll be able to have access to those dollars. So you can still have the house. You can pay it off 5, 6 years, 7-year average, or you can keep leveraging and accessing those dollars as the line of credit. Which would you want? There's kind of two choices there. People think just the mortgage, but I would go with a HELOC.
Listen to you. You sounded somebody that just did it 2 months ago.
Yeah. It's great. I'm so excited. It's a great thing. Everyone should look into it when it's
Answer me this, because now I have a question on that. Of course, first lien HELOC is definitely the way to go with that. But for a first-time home buyer that's looking, in most first-time home buyers want to put the least amount down, like FHA.
That's the thing. Yeah.
So with the HELOC, the first lien HELOC, Joe, correct me if I'm wrong, you'd have to have 20%, right?
15.
Whatever the difference
15.
is.
Okay, so that's not too bad. So I guess if you could afford the 15% down, then definitely what Bree just said is 100% the way to go. But if you can't, you might have to go with the FHA route, 3 to 5% down, and then kind of season the loan over the course of a year, then refinance it to a first lien HELOC so that you can then do exactly what she was saying, where when you make extra payments, you actually have access to the capital instead of just like, hey, it's in my walls of my house, sort of.
But when you do that, you need to calculate the PMI on, because an FHA loan, the PMI stays on forever until you refinance or pay it off, and that's just another way for the bank to screw you out of money.
It is, but Joe, unfortunately, the only problem with that is sometimes that's the only option for first-time home buyers. With the price of housing right now, I mean, a lot of times you're just getting screwed. First and foremost, first-time home buyers are literally I almost call it it's predatory. It truly is predatory. Like the PMI and just all the fees on the loans and just everything they make you go through. It's terrible, but it's either that or no housey for you.
Yep.
Sucks. It's a bad situation, but that's why we kind of need to get back to just the way it was in the 50s, where we actually saved money and then went and bought a house instead of I can just buy a house because there's these programs that I only have to put 3% down. I can have my own house. Yeah, but look at how much you're actually getting screwed with that mentality.
Get a policy, save up your money, utilize the policy, then you can use that for the 15% down payment, get into a HELOC, do the one-pot system, and there you go.
The way you guys just described it, it sounded like you're meeting that demon on the crossroads and signing over your soul to get into a home or something like that. Did anyone else hear that? Because that's what I was present to. So,
and give up your firstborn too. Don't forget about that.
Yeah. Yep.
Assets versus liabilities.
That's right. That's right. There you go. We can go that way too. So if you have a mortgage, you have a liability. That house is not an asset. When does that house turn into an asset? When you get a HELOC, you utilize the equity, you put that into motion, you have interest coming in, and then the house pays for you to live in it. Now you created an asset. But until that day, you're stuck with a liability.
Well, it came up on this morning too. Conversation was like, if a bank's going to give you OPM, which is an asset to the bank, liability to you, are you going to take that asset, which is the cash they give you, and then go put it into an asset that creates value, or a liability, which is a home?
Exactly.
Another way to look at it, I know it's kind of getting into the weeds a bit more, but man, that's a mentality. It's a mental thing, which is mentality. It's your programming. It's your mindset.
You guys keep talking about their thinking, I think.
You thinking that? I'm thinking that.
Yeah. That's an interesting thought.
Yeah.
Who would have thought?
I don't know.
Michael is saying to you, Joe, I thought I heard you say that we don't want any cash value remaining in the policies. Am I remembering that correctly?
If you're utilizing your HELOC correctly, what's pillar number 3? Money not in motion does not make money. So if there's cash value in your policy and you owe money to the HELOC, you're losing interest there. Yes. And we need to have the one pot system, acquire another 50, another 100, deploy that out to make more interest and more cash flow. You are correct.
And the beautiful thing about this is you'll hear different perspectives. Like Joe can't sleep if he has a penny in his cash value. Me, on the other hand, I've got plenty of cash in my policies, and I almost paid the HELOC back again. And I'm okay with having big piles of money laying around doing nothing because it makes me sleep better at night. But I also, what I do is I release it, have everything that's out, pay it back, and then I'll release some more, have it all pay back. So you'll find that of all the people here, everyone does something a little differently. But like, you're like full steam ahead, and that's fine. And I'm not full steam ahead.
You have to feel comfortable with what you do. You have to have a fund that you feel safe with, the leftover in your HELOC, in case something happens. Depending on cash flow, as you become more of an investor and your cash flow comes in more per month, and you were saving up $20,000 in that HELOC just in case something happened. But now what happens when you get to, now you have $30,000 in cash flow coming in a month? Do you really need that $20,000 in the HELOC, or do you have it coming in now? See what I mean? So now you went to the next level and went to the next ladder. So now your perspective changes.
I was going to say, Joe, when you started, were you as aggressive, or was it confidence that was built up over time? I mean, you've had some losses, right? It's not all, unicorns and rainbows as we've described. So
I'm a true investor.
That's one of the things people that are, I'm asking because people that are new are thinking things like, hey, saving's bad if it's sitting in my HELOC or sitting in my policy. I got to move the money right away because it's not making money. Like if they read the thing on your wall. But at the same time, like I know Chris is sitting on a bunch of money, cash value in his policies. Craig just said he is. I have some for safety, not as much as maybe I'd want to right now, but I have a lot out working too. So I'm kind of stuck in the middle of which one am I doing? So it's very much based on our philosophy, where we're at, our confidence level. Like, where were you when you started?
When I started?
How did you feel? Like, do you remember?
Well, I mean, with Chris, I just went home, grabbed the check, and threw $250,000 at him in 16 minutes. But
that wasn't start. You'd already paid off your home like 3 times at that point,
right?
Oh,
yeah, right. Okay, so you're talking all the way back to the beginning?
Yeah, you had a beginning. I mean, I know you're OAF, but you remember, right?
Yeah. When I was living on bologna sandwiches and eating.
That's what I'm talking about. That's what I'm talking about.
Then?
Yes. When other people weren't paying for your gas, when you were paying for your gas.
Well, that's when I was flipping houses and had 12 doors and tenants not paying me, and running around and utilizing the money that I had and scrimping and going from rent check to pay this bill, to they pay that bill, to pay that mortgage, to pay that HELOC. And once there was some wiggle room, yes, I then moved it out, but I kept some away. Just as I said, you need to still feel comfortable with what you have but be able to put the others to make cash flow.
So there was a book, and I can't remember who wrote it. You guys might know. It's called The Road Less Stupid. And the guy talks about thinking about the second order consequences. And so this is kind of how I think about things is if let's say I'm deploying money for my HELOC and I'm putting it somewhere and I lose it. That's a second order consequence of, okay, if I lose it, now I've got that money's gone and I've got the hole in my HELOC. How am I going to recover from that? So I'm not saying there's any one way that's right or wrong, but you have to figure out for yourself, if you're doing this and you're putting this money in this investment, and the way I think is like, if it went away, how am I going to recover from that? And am I okay doing this? Okay, yeah, I am. So release, here we go. Not that I want to lose, but I have lost money. Joe, I know you have, and it sucks. But I've recovered from it because I did it in cautious ways. So that's my only thought is, just you got to figure it out for you and how much you want to leverage and how much you want to leave in your opportunity fund, because there could be some buying opportunities coming up.
I love it. I just want to rifle through a few quick questions real quick. So Pinez just said, can I still get into the March Madness training? If so, where do I sign up? And I just put that in the chat. moneyschool.tv/MMM for March Money Madness. And then this one just came in, and I'll hop back up to where we were in line, but I thought this was a nice question, is do the mentors talk to other mentors about how to answer us when we have our appointment? Because I'm sure everyone has different life experiences, client issues that others haven't dealt with yet. So I wanted to hit on this one for a minute here.
Yeah, at the end of every day, we go and we plug into the matrix and we download each other's brains, and then we share in between this group and our hive mind. It's
Neuralink, baby, Neuralink. Being serious, we actually do. Like, there's multiple cases where there's several mentors working on one case to solve the problem and bring different ideas. I mean, Jason, our one client that we're literally at the finish line with, like, that took an effort of 3 people. Because it was just we just needed different perspective and different ways of getting, the problem solved for the client. And, sometimes we just need to get exceptions from the insurance companies to make certain things happen in rare occasions. So, yeah, that happens all the time. I mean, we're a team and we work together.
We also meet twice a week and literally do that. Just talk about cases, what's going on, what people are hearing. And then we have a couple internal text message threads that are constantly being discussed with cases and stuff. So yeah, you're getting not just an agent and a mentor, but an entire team.
Yeah, we do this, at least. I mean, it's awesome. It's an awesome question. I really appreciate the question. We do this every week, right? We're on Ask Me Anything every week, and we don't know what questions are coming. And we had a meeting today before this. We have a meeting Friday. We talk during the week about cases and what's going on to help things. And we're learning stuff every day. Like, I learned something from Sandra Fry, the head of our application team today, that, look, everyone that's nodding was on that same meeting. Like, I didn't know you could do that, right? Like, I didn't know you could do that. And Ethan's been implementing and acting and working with his own policies and helping all of our clients and his own clients for a long time. And he never heard that. I never heard that. So until we have a new problem to solve, we're not necessarily learning that thing until it's there in front of us to solve.
And Joe and I do all our calls together. So we're our own spouses call us work spouses. He's my so yes.
Again,
work makes the dream work.
All right. Chelsea's saying, do you have a sample or layout for stipulations for kids to have access to a death benefit? I have 2 teenage boys and I'm struggling to put together those stipulations for them to access funds.
You guys have that Garrett Gunderson? Do you have that Garrett Gunderson? Anybody have that resource? I think it was shared among our team at some point where we had his family constitution, how he kind of laid that out. I mean, that was a good example.
Yeah, we just gave that away today. You can get that with the March Money Madness bundle.
There you go.
The M&M deal.
Yeah, I'm not sure if I'm reading or hearing the question incorrectly, but the way I'm interpreting this is she's saying you've got a policy for your kids and what are the rules for how they use that cash value?
But I don't know. I'm
And-
scared because it says access to the death benefit. I don't really.
Yeah, no, I'm thinking if she passes away,
If she
like
passes.
they get it all immediately, or setting
yeah.
up those like you got to wait till you're 30.
Yeah.
That would be an attorney question right there. I mean,
Why don't we, hey Chelsea, can you kind of rephrase that question? Are we talking about cash value or the death benefit? Because it's a drastically different answer depending on what we're talking about. So instead of us kind of trying to pick apart and guess what it is, could you just rephrase the question and repost it?
Yeah, and I think just for the benefit of the people on the call, I mean, if it was death benefit, yeah, trust can take care of that aspect of it. But if it's a cash value, and you're going to use, say, the kids are ready to buy a car, then what I do in my own situation is I create a promissory note for a car loan I have with my daughter, and like, you know, this is the rate you're paying back, these are the terms, and if you don't pay it, I'm coming to get your car.
That's awesome.
assuming you're the owner of their policy too, so you're kind of the gatekeeper.
Yeah, so it's just like here's the family banker dad, and he's loaning money so you can go buy this car, and then you're going to pay it back, and it's in a note, so it's in an actual promissory note.
And Chelsea gives us a little bit more clarity. I don't know if you guys can see that down the last couple of things, but it is so. Like I was talking to someone that's a third generation banker. They have 70 policies. They have like $156 million within that trust system. And what they haven't done as a family, which I was actually pretty surprised, is they haven't they have stipulations like you have to be 26 before you even know that exists, like before you're even made aware. But there's no education going on in the family. So like your opportunity right here is to start educating your two boys on what's happening, what it is, and then you can put in the stipulations in place. You know, like they have to be using it for X, Y, and Z, for some kind of personal development, for starting a business, and they have to have this in their life going the right way, whatever you want to put, right?
I think she's asking if we have anything kind of in the guideline of that. And I don't know if we do, but I would check looking into, that's where you kind of look through history. What did the Rockefellers and the Rothschilds do? Don't repeat what the Vanderbilts did. We can see when you lose the financial literacy, the money goes away. So we want to make sure that education is first and foremost, and it's never too early to start teaching your kids about the truth on this type of stuff because it's entwined with everything.
Well, there's two things. One, get a legal professional to help you with this technically. So that's the first one right there. Second off, what's more important to pass on, money or knowledge? They're both very important, but if you don't pass on the knowledge, the money will be destroyed. So you've got to make sure you're passing on the knowledge as well. So I let the legal or professional people help you with that side of it on the technical side, and then you focus on the education, knowledge side. That'd be my recommendation. That's what I'm doing. So with my family.
I think we lost our moderator. Where'd Shauna go?
Yeah, where'd Shauna go? She got kids.
Is there too many people again?
No, she's right there.
Will the USA government?
I got it for you. All right. She said, let's see, Canada Accounting for Students said, will the USA government revalue gold?
I wouldn't. That's a whole long conversation right there, but I don't see that happening.
The U.S. government right now owns more gold than any other country. I mean, they already know that it has value.
Wait, how would they revalue gold? What does that mean, though?
Yeah, I'm not sure what you mean. Like, reconsider it as being a basis for the banking system, like currency. I don't know.
Going back to the gold standard, but
yeah,
that would take a monumental effort.
Wait, does everybody know what they're asking here?
That's what we're trying to translate.
We covered this in my YouTube channel. So essentially what they're talking about right now, the value, the way that they value gold, the government is valued on it, I think in 1971 or something to that extent. So the gold valuation is based on the pricing back then. So what they're saying is doing, a readjustment of that gold pricing and bring it up to today's gold value, like where it is. That would give like, it's I can't remember how much it was. I literally have a YouTube video on this where it's like billions and billions of dollars that it would create for the government without taking on any debt, printing any more money or anything. It would just create money. But the only issue there is because gold is valued so high right now, if gold were to go back down, now you got the reverse effect, right? So do you want to revalue when gold is at its high point? And that's the controversy right now of whether or not they do that. There's like three things on the table for what they're talking about doing with the gold. And that is probably the most logical one. I don't know if they'll do it though. I really don't.
I wonder if we can find that link. That would be good.
I could ask Jordan to give it to me. I don't know where the YouTube video is. It might not even be done editing. I mean, we've got a pipeline.
Recent, got it.
Well, with all the stuff going on in the economy, I mean, Sean has had me working overtime and double time doing recession videos on what to do, and gold is a big piece of that.
Mama Bear, you gotta lighten up, man. I know it's so much.
All right, fine. Okay, so the next question is, if a policy has MEC'd, and assuming that the policy has less cash value than what was paid in premiums, would the cash value that's taken out via loan be taxed?
I mean, it's a modified endowment.
No, if it's MEC'd, and you took cash value out, anything above and beyond your cost basis would be taxable. Only above the cost basis. So if you're just taking money, your initial premium up to your initial premium, that like the amount you put in, then that's just return of money you put in. Anything above that, it's just like a regular investment. So you don't pay tax on anything but gains, right? So this is no different.
And your policy should have a definition page telling you very clearly what a MEC is, a modified endowment contract is, and how that impacts the policy. You should be getting alerted. We don't want those happening with the policy to be billed. I know that for a fact.
You just don't want to MEC your policy. I mean, it's not as big of an issue in the near term, but in the later years, you're screwed. You're literally screwed in the later years with a MEC because of the compounding nature.
I will say too, from the implementation side, like I have occasionally we get those notices from the insurance companies where a client accidentally, fat fingered a button or sent too much money in, and there is a little bit of a grace period there to be able to say, oops, my bad, pull some of that money back, but before you really cross that threshold. So there's a little bit of.
They actually send a cool email. At least some of the companies send a cool email saying, "Hey, you MEC'd your policy. Did you mean to MEC your policy? This is what it means that you've MEC'd your policy. If you didn't mean to MEC your policy and you want to return it to a non-MEC status, we will send you the money back if you contact us within a certain amount of time, usually 30 days. So, you can do silly things. I've heard crazy people like, the man who started all this, Brent Kessler, purposely MEC a policy or send in too much money just to see what happened. I think that sounded like just crazy, but I think him and Devin both have done that. So.
Yeah, but you just get notified. You just take the money out and all is well. But if you don't take the money out, then it's bad real quick. This just in, I got to hit this. So Steve, one thing, $47 per ounce, I believe is what it is valued at, which you can kind of just do the math and figure out on the 8,000, tons or whatever metric tons that they have of gold. It's a lot of money. But Trump just announced 25% tariffs on all cars not made in the United States of America. How I look at that is just like Japanese cars back in the 80s. They were made in Japan and they tariffed the hell out of them. Guess where they're all made? In the U.S. So it looks like Porsche's coming to the U.S., baby. All right. Anyway, back to
this one might be for you, Chris. So Tony and Angie Stewart are saying, I just got into MSTV with all the regular content that is available and being updated on the YouTube channel, plus all the great content we now have access to. How would you prioritize going through all of it?
That's a great question. And this is something we've been working super hard on with MSTV, because I understand there's all these webinars and everything. What MSTV would be used for is specific things. Because you don't know what you're going to get with Wealth Webinar, right? Like, we're going to do our own topic and maybe it's a direct hit for you, but maybe it's not. My YouTube channel, maybe it's a direct hit for you with the video you see, but maybe it's missing what your needs and goals are. When we're doing the MSTV stuff, it's going to kind of like this, but there's going to be a lot of coaching type webinars where we're doing a webinar for MSTV webinar or MSTV members, but we're directly talking about what the viewers want to talk about instead of just rattling on a topic just because I chose a topic or Shauna picked a topic. It'll be directly focused on specific needs or specific categories, and you can pick and choose which ones you want to watch, because maybe you want to learn how do I do private lending with my policy? You could go to that coaching session on MSTV, and that's all they're talking about. And those are the only case studies they're showing. So we're still building it out. Thank you for being an early adopter. Obviously, great things don't happen overnight. So we are slowly building it, but your feedback and that question really helps us drive home what MSTV is going to be and how it's going to differentiate from all the other stuff we're doing. And that's how we do it. It's a direct hit for what it is you want. You pick and choose what you want to learn, and you only tune into that stuff that's your category of what you're trying to accomplish.
All right, I love it. I got 7 questions left right now, and we'll kind of go through them real quick. So Jared is saying, if we put one lump sum in, is there still a premium payment each month?
If you mean dumping, then yes, or annual.
If you mean single pay, then you're probably not going to be having a great IBC policy.
Yeah, I know Jared doesn't mean single pay. He knows what it is, but
Yeah.
Well, if you were to put the dump in and your annual premium, you're done for the year, and then next year you would put in your next annual premium. So you could technically fund everything up, in one big pile of lump sum and premium and be done with it for the year.
Yeah, so the most would be you'd have to pay at least next year something.
Mm-hmm.
Derek is saying, do you make a monthly deposit or an annual deposit, or could you do either way?
yes.
Monthly, quarterly, semi-annual, annual.
I do most of mine monthly. I think, except for Vivi's policies, I do annually, and I have one I do quarterly. That's just how my cash flow comes in. So I tied my cash flow to the way I'd fund my policies.
And then I think that we should do a Wealth Wednesday webinar on that maybe in 2 weeks. A lot of our examples are annual, but then a lot of us practice monthly. So we definitely need to bring that full circle. Justin is saying, is it more advantageous to do a front load or to do a back date policy and put 2 years worth of premium in quickly?
I don't think we can do that anymore.
I thought we can only go a couple months.
I think
2 months.
3 to 6. I thought.
And it's only due to a birth date.
Yeah, I thought it was 6 months.
I think it depends on the company.
Yeah, it depends.
Might have to do the dump in is the answer there.
Maybe both.
Yes. Okay. So we have no credit card debt or car payments. We have mortgage debt and 2 rental property debts. We have $40,000 available in a policy, and adding a $40,000 to a mortgage doesn't pay off the mortgage any faster. Not sure where to start. Do we refi a first lien HELOC or a regular HELOC so we can get $30,000 to $50,000?
If you do
I keep the mortgage when you get a HELOC.
If you do a second, you're still taking money and putting it into your 2x4s with your first mortgage. If we have a strategy call, I can calculate it out. We'll have a call with the bank. We'll put it in the magic calculator to show you apples to apples, to show you which works best with the numbers. But if you were to consolidate everything into one pot, then it makes things a lot simpler.
Yeah, I agree with that. Yeah, I definitely wouldn't take the $40,000 cash value, dump it on the mortgage to make principal, because then you're just, again, the money, like Joe said, is just going into your rafters. You're not getting any economic benefit from that. So therefore, you're actually putting yourself in a worse cash flow than you are today, because now you've got the interest on the loan from the policy, and you created no new cash flow and no recapturable money by paying down the mortgage. That's why mortgages are tough. In the video that we do, the 90-minute video, you see that in 1 year, in year 5, where he makes a principal payment. He takes a loan from the policy, makes a principal payment on that second that second house that he had, and you notice that year it created no additional capital. You would not want that to happen if it was any longer than just a year. And then the next year he had enough money to wipe that mortgage out, which then really supercharged paying off his primary house. But maybe rewatch that video. That's part of the video in the 90-minute, because you'll get some perspective of like how that would look. But you're not thinking wrong.
Okay, and then Jet Set Life is saying, for Chris, I filled out the Google form to do equipment flipping with ARC, but I haven't been contacted yet. What should I do?
All you needed to do is comment, and Sean already was all over ARC about calling you back.
Yeah, I sent a screenshot of your comment, so he'll be reaching out. I do want to just say a little disclaimer about the forklifts, is I know that I personally was in that video, and my example was 3 months and 5 months. And I know that that's not the standard for everybody. So
they've been taking longer in winter. This winter was rough, I guess. So like the lifts were taking a lot longer to sell this winter. Mine, same as yours, Shauna. Mine I think I did 3 of them. They all sold relatively quick.
Yeah, but some people go over a year. So just big disclaimer there, especially because.
But the return's still good if you go over a year. You know, it's not great, but it's still good for the amount of risk you're taking there.
Derek Olson is saying, would you be able to change the amount you deposit in the policy every month with fluctuations in living expenses? I want to put my remaining cash flow into a policy. Can I put all my money in there?
I'll say sort of. So you know, if you're set up on a monthly premium, you're set with the base and paid up additions of what you're putting in. But if you have a loan already against the policy, then if you have extra from your monthly cash flow, then you could easily flow that back in to make extra, one-off payments towards your cash value. But otherwise, no, if you're on a monthly premium, you're set there. Or then the next thing I talk with my clients about is, okay, if you're once you're at a good point, then when it makes sense for you, you can bump up to a quarterly, semi-annual, or annual premium, and then put a larger chunk in, and then you're saving it up. But the paying back the policy loans, that's a good thing to do if you've got a little bit extra at the end of the month and you want to put that money to work somewhere. Paying back a policy loan is an easy one, and that's before even getting into all the fancy stuff with the one pots, first lien, HELOC stuff. So.
I completely agree. I would say just start paying back your loans so it's just sitting there waiting. Jet Set Life is saying, I want to flip luxury watches, flip used cars, and buy Section 8 houses. I want to use percentage credit stacking and business funding to get up to 100,000 plus. Is it advisable to use IBC to do this?
It's a good way to hedge against everything else that you're doing.
Mm-hmm.
I would say infinite banking, if you follow Nelson Nash's teaching, it's a long-term strategy. And everything you just mentioned doing sounds like you want to get rich quick. They're not going to go well together, I think.
That's true.
I mean,
that's what I was thinking too, Carson, when I read that, especially when you're I've talked to people who are using the percentage credit card stacking and all those things. Like you're not focused on saving. You're not focused on the first fundamental wealth building. Chris talks about the richest man in Babylon all the time. First principle is pay yourself 10%. Where are you paying yourself in this scenario?
Nowhere.
And I'll go back to the second order of consequences I was talking about before. While you're doing it, it's working great. But as soon as one of those pieces of the puzzle breaks, then you're in trouble.
And more importantly, like focus on one of those businesses too, in my opinion, like launching three. Those are three separate companies. I mean,
a lot of full-time work.
Right.
So the short answer is not exactly advisable to use IBC until you figure out the business of making money first, and then how IBC can support that.
I agree.
Dennis is saying, is it best to ask your implementation specialist how much over your monthly deposit can you do without mecking the policy?
There should be a little tool that your implementation specialist gets out to you that tells you which carrier you're with, and it gives you the exact steps for how to find out how much room you have in your policy. So I would check. I only say that because I got mine from Jerome with my new policy that I started this month.
Yeah, I cover that with all my clients of showing them where the MEC threshold is at, and then telling them depending on whether they're on a monthly or an annual premium. I like to say check once a year, and it can depend too on like, okay, are you on a monthly premium with a dump in, and there's probably not very much room to make a PUA catch up up to the MEC. And so on. But I like to make a habit of at least once a year, let's check, let's contact the insurance company, have them run the test, and then we know exactly how much we're safe to put in up to that threshold.
Dennis, I'm texting you the question to ask. You send to policy services. I'd actually ask on a monthly basis just to get used to weighing in and knowing where you're at. And you can do it quarterly. You can do it annually, semi-annually, same way you pay your policy, but checking monthly is not going to hurt because it's going to teach you, we're teaching you to be a banker. So go see what's going on, find out if you can put additional in, because with your policy we designed, you're going to get more than 90 cents of every dollar. It's going to give you like any PUAs that are extra you can put in. It's more death benefit first, because anything that goes in their premium deposit always buys death benefit first because it's whole life insurance. Number two, you get more cash value, because they're going to be equal at the end of a contract. So if the death benefit goes up, your cash goes up, and it's going to increase the dividends when you get dividends. Like it should increase your dividends. So those are the three things. So checking every month, I'll send you the email that you can ask, and it's something you should do. So.
I love it. And then shout out, we've got someone currently in the underwriting process, had their exam and just got the results. Super excited to get the ball rolling. And Jason, maybe you know this, but husband or daughter cannot get a policy. We are fully funded. Where else to save money except, what's HLS stand for? Do you know? Health Life Savings? Like an HSA?
I don't have an answer. I don't know.
Weren't-
What would be next? I mean, having business partners, maybe.
It's probably supposed to be a high yield savings. Sorry, it's probably a typo. I guess.
Oh, okay.
But other options, other options here could be maybe it's not a matter of resources, maybe it's resourcefulness. Are you able to go out and form any new partnerships? Is there an insurable reason in a business you've created? Other things like that. I don't have,
Yeah,
you were the one that was also considering refinancing to a first lien HELOC. That if you were to look at that avenue, that would be your savings. Generally, is that line of credit, that HELOC. Because if you think about it, if you had just $100,000 that you still owed on the HELOC, then you had $100,000 over here in your savings account. You're paying 8%, whatever the interest rate is on that line of credit for those dollars not being paid off. So turn that into the savings. You have X amount of time. That's what I've been utilizing mine for, is the one pot system that Joe teaches.
And then Mike's asking, what carriers do you all work with?
One America, Lafayette, Mass Mutual, Security Mutual Life, and Guardian. Am I missing any?
Nope.
Okay.
Got him.
And then Justin saying, do a lot of people in IBC keep buying lots of policy over the years, or is it common for people to slow down as they accrue a certain amount? Everyone I hear seems to actively be adding policy.
Yeah, people definitely slow down. I've slowed down. You get to a certain point where you're funding. The whole idea is you're gonna add policies when you want to increase the amount of capital you're putting into your private banking system. So if you have extra income coming in and you want to save more as your income goes up, then you add additional policies to increase that capital going in. Or more commonly would be, I'll use Joe. Joe moves his money out of his policies, lends that money out. That creates additional income into his household. Then he wants that income to be able to go back into the policy. And remember, your policy, when you take a loan out, you can only repay the policy up to the amount of the loan. So what eventually happens is you bottleneck, and now all of a sudden your segregated bank account starts building up a bunch of money, which is the interest that can't make it back to the policy. I've been there, and then that's when I've added policies, and same thing with Joe. I'm just hoarding cash right now. So I've slowed down because I'm a hoarder right now.
It's the best emergency savings vehicle, though. So
I just think there's going to be, I think it's going to be like Walmart rollback 10x. so I'm just waiting.
Kmart blue light special.
Yeah, I'm in no rush to deploy capital right now. I'm waiting for the blue light special.
I used to run the blue light special, so you just wait.
All right, and then Koo Cobb is saying, what software apps do you have to keep track of all the finances? Do you teach that?
Ooh.
Greg has
this used to be a pain point for Chris.
Greg has a spreadsheet for it.
Yeah.
I have my own spreadsheet, which is not very sophisticated. It's only got 4 policies I'm tracking. So I keep my own spreadsheet, a Google Sheet. I know, Chris, this is a big pain point of yours at one point. Didn't you hire someone that's kind of managing all that at this point?
Yeah,
find your
Brandon does, but it's all spreadsheets. All I would just say is, can we just put a pin in this question and come back to it in 7 to 8 months, and then we can have this discussion again. Pepe Le Pew will deliver.
Stay tuned.
Yeah, stay tuned.
All right, and then this last question, we'll stop here. It was a little long, and I didn't really get it totally, but let's have an example. If you have a $1 million policy and you put in $400 to $500 in premium, I'm assuming that's $400 to $500K. What would be a safe amount to pull out to invest in, say, 6 months?
I'm confused with the 1 million policy. It
I
sounds
think
like
they're talking death benefit.
compelled cat. I think the 1 million is you're kind of saying I've got $1 million death benefit policy that I'm putting 400 to 500 in premium. You got to understand the way we design and engineer these. We never like that would be a regular whole life policy because like you're buying a death benefit and then your death benefit cost 400 or 500. So just reverse that and just say, I want to build a policy that I want to put 500 a month in, 400 or 500 a month in. We're going to then go to the MEC rules. Okay. And we're going to say, all right, what's the minimum death or what's the minimum death benefit we can put on this? And it might be $200,000 death benefit. So we're going to put a $200,000 death benefit that matches the 400 to 500. Now your policy is incredibly efficient because you're not paying for a bunch of death benefit that just cost every penny of what you're putting in. So then once it's designed properly, the safe amount to pull out and invest would be whatever your cash value is in the policy, which would be anywhere between 60 and probably 80%, 80, 85% if there's no dump in that you'd be able to use in that first year. Compelled cat, you got to kind of the way you're thinking about it is the traditional whole life. Like that's your traditional way of buying life insurance. Remember, we're designing and engineering these policies to work for privatized banking and the infinite banking concept. So it's just a completely different mindset of how these things are created.
Yeah, and the other thing too, if you put in 400,000 to 500,000 in premium, your death benefit's probably going to be somewhere in the 8 to 10 million range, depending on your, health and ratings and all that stuff.
Are they talking 400 to 500,000 or 400 to 500 a month?
I don't know.
400 to 500 a month. I think they're talking about term policy.
Oh, I didn't know if it's 400,000.
I like where your head's at, Craig. I do. I don't think that's what we were doing here. I mean, there'd be a K after that.
Well, yeah, if there's a K after that, because I'm working on one right now where there's about 800,000 going in, and the death benefit's up in the 16, 17 million. But I think the other question I'm seeing in here is, what is the safe amount to pull out? And I think that's where it comes down to individually, how much of that do you want to keep in reserves for, like what we were talking about earlier with Joe is like, what do you want to deploy and what do you want to have sitting there for a safety net?
And what problem are we trying to solve for you? Bringing it back to what problems are we trying to help you with in that first strategy call?
Yep.
So if you're trying to deploy X amount to get, a certain amount of income coming in from that investment, that's one thing we could back into and figure out those numbers. So
that's how me and Chris did it the first time. He's like, what do you want to do? I says, I want to buy a condo in Myrtle Beach. How much? 175. He said, okay, throw 200,000 in. There you go. There's the problem. We solved it. Ran it through the policy.
For sure.
Shauna's computer died, so we are now in charge, everyone, just so you know. So we're in charge. So Shauna's okay. She hasn't been injured. She's okay. Her computer just died.
Yeah, let's get this baby wrapped up. I can finish these questions.
I didn't even realize what time it was because I'm not going to Taekwondo tonight. So
I was going to say, it looks like I only see one more.
I'm going to give a quick Connor Sipple, Patty Sipple crushed the testing tonight. You guys are testing for Taekwondo. It's our quarterly testing, so they're going to get their butts whipped. So have fun doing it. Celebrate. Yes, you can. Anything else? Steven, we going to wrap up?
We got any more?
I don't think so.
I think that's it.
We did it.
Wow, we made it. All right. Well, folks, thanks so much for your questions. They were really good ones today, and keep them coming because we do this show every single week. Same great time, same great place. We will see you tomorrow, somewhere, somehow. Thanks for joining. We'll see you then.